Welcome, Easy Equities users. It's great to host a webinar again. It's been a while, and I'm particularly delighted today because I'm joined by Nico from Satrix, who's a very important partner here at Easy Equities. Sanlam, of which Satrix is a part, owns 30% of us. We love the Satrix products. And Nico's head of portfolio solutions at Satrix, and he's going to be chatting to us a little bit about ETFs in general. It's a good time of year with tax season approaching an end, but Satrix is always at the forefront of new and innovative ETFs. So welcome, Nico. Thanks for joining us.
Thanks for having me.
And maybe to kick off, tell us, what does a head of portfolio solutions do? What is your daily job?
I spearhead a lot of the research that we do into new products, into positioning our funds to clients. You might think that Satrix is, or there's a perception in the market, I suppose, that Satrix is a passive business and that we only offer vanilla solutions. That can't be further from the truth. We actually offer a lot of solutions that's tailor-made for clients. So a lot of those, the research into that, I would spearhead, as well as our factor research. I work quite closely with our CIO, as well as our quantitative portfolio manager to put together these funds and these strategies, look for new ways, new products that we can bring to market. So there's a lot that happens on our side, and yeah, just enjoying the business, enjoying what we offer clients, and looking to always improve our offering and bring to market solutions that our clients can help them grow their wealth as well.
Yeah, and I think one of the benefits we have on both Easy Equities and also Satrix now is, as retail investors, we get a lot of the benefit that your institutional clients get, and the work that goes into servicing these massive institutional clients. We get the benefit, so that's really lacquer. But let's kick off, Nico. I want to understand, why do so many ETFs have similar names? And there are so many acronyms. And maybe you can just help users understand a little bit about what some of them mean.
That's a great question. So different providers have different names that they attach to their ETFs, and there's no hard and fast rule. It's more convention. So for example, your Satrix ETFs, you'll notice they all start with STX, and then typically the latter part will give you a clue as to what you're investing in. So take, for example, STX NDA, that is Satrix India feeder ETF, or STX CHN, that is our China feeder ETF, or even just STX T40 for the top 40. I mean, it's typically quite intuitive, but what you generally have is the first part of the name just giving an indicator for what asset manager actually manages the ETF. US ETFs are actually a bit more adventurous with their names. Some of my favorite are the TGIF ETF, which pays its distributions on a weekly basis, specifically on Fridays, as the name suggests, or the BLNG, or the Bling ETF that invests in precious metals, or the Barn ETF that invests in agribusinesses. There's also a TAN ETF that invests in solar. So a bit more adventurous with their names, but in South Africa we're less adventurous, quite more to the point. And I suppose just for clients, it's easier to understand exactly what they're investing in by the acronym.
I think we're going to have to get a couple of Easy Equities retail users together, buy you a couple of drinks one Friday when you've got a new ETF, and brainstorm a new name. So I like something interesting. But based on that then, Nico, are all of these ETFs then really the same? I mean, the Satrix top 40 versus another provider's top 40. I mean, are we saying that basically all passive, it's the same thing?
Again, great question. Look, ETFs definitely are not all the same. And over time, we've seen an evolution in South Africa from mostly simple vanilla ETFs to your more bespoke type ETFs that track specific styles, like, for example, momentum or growth or quality, and also specific themes as well. We, for example, have a local inclusion and diversity ETF, which is anything but vanilla. We also have several global thematic feeder ETFs, like our infrastructure ETF, or our smart city ETF, or our healthcare ETF. So these are anything but vanilla. You are right in that there are some overlap. So there's multiple, for example, top 40 ETFs, and some different providers of different ways of constructing it. Sometimes the fees differ, sometimes distributions differ, the timing thereof, for example. But generally we are seeing that you're getting a broader range of ETFs that offer investors exposure to different underlying. And the whole appeal of an ETF is that it gives investors a low cost and a transparent way to invest in well-diversified funds. That's the key. And we know the new generation of investors highly prize transparency, and they want to know how their money is being invested. And there's few better ways actually doing this than using an ETF. And another key benefit of ETFs is that it doesn't have fee classes. So you mentioned that at the start, but that's a very important thing. So in unit trusts, you have fee classes. And I don't know if the listeners know this, but if you look at any unit trusts, MDD, or minimum disclosure document, you will see different fee classes there, for example, and depending on what type of investor you are, you will be exposed to different fees. And generally, if you're the man on the street or a retail investor, you're likely going to be in the highest fee class. Whereas with ETFs, you don't have that, right? Everyone is investing in the same fee class, and so whether you're the man on the street or you're a large institutional investor, you're all investing in the same fund, same strategy that trades on the JSE. So you get that benefit of a far lower fee class through an ETF.
Obviously, I think it's a great point. So on Easy Equities, we've got a tool, compare.easyequities.co, so that allows people to explore between different product providers, things like costs, and I think it's very important. I suspect few people need reminding that Satrix was the first in the South African market, and that's what, 25 probably odd years ago. I think I speak under correction, but certainly the first. So you guys have been around a long time. This is not your first rodeo. And with ETFs being available in your ZAR wallet, TFSA on the Easy Equities, it's not just that you can access it in one place. And so based on that, Nico, maybe just talk to us a little bit about local versus offshore, because again, does this limit me buying ETFs being local, South African? What kind of exposure can we expect through some of your products?
So very simply, an ETF, look, it's a fund or a basket of shares that trades on an exchange. The underlying can differ, and there's no limit to what it is ultimately that you're holding in the fund that you are tracking. So it means you can buy and sell shares in an ETF the same way that you can buy Shoprite or Naspers shares. Locally available ETFs are listed on the exchange, but that doesn't mean the underlying needs to be local assets only. So in that way, ETFs it's actually similar to unit trusts in that they have the same regulations, and holders have the same comfort that they're in effect holding the underlying, but with a far lower total investment charge and more transparency, as I mentioned, compared to, for example, unit trust alternatives. And look, at the end of the day, an ETF needs to track an index, which simply means that it is a set of rules to determine what instruments are held in the fund. Now, these rules can be very simple, like a top 40 ETF or an S&P 500 ETF, which just means you're holding the 40 largest companies in South Africa or the 500 largest in the US. That's a very simple rule. Or it can be more bespoke, like having a theme or a style component to it, like I mentioned, some of our thematic ETFs. Now, the manager of the ETF then simply ensures the ETF mimics the index exactly. So all the work is done in the background to construct the index or the set of rules. And then after that, the manager simply tracks that set of rules. So you have full confidence that you know exactly where you are invested in. Now, since launching the first global feeder ETFs in 2017, or Satrix was the first to launch feeder ETFs in 2017. Since then, we've actually seen several listed since. Now, a feeder ETF, and to your question, are you kind of constrained when you're a local investor to only invest in local ETFs? The benefit of a feeder ETF is that it simply means local investors buy local ETFs with Rand that feeds directly into offshore listed ETFs. Now, this way, it is exactly the same as holding the offshore listed companies directly, but without the currency conversion costs and all the other costs associated with moving money offshore or repatriating those proceeds back to South Africa. So this means you can access our global feeder ETF range at very low costs, getting all the benefit of the underlying exposure. And to this end, we've partnered with BlackRock's iShares to list several global ETFs, meaning that you, the investor, you get the scale efficiencies in costs and tracking capability that's offered by the world's largest ETF issuer. and you're feeding into it through Africa's most experienced and largest index tracking business as well. So this gives you peace of mind that you're getting global exposure and a good rand hedge without the costs and effort of having to physically move your money offshore and keep track of that and all the other costs associated. So feeder ETFs are actually a great way for you to get global access to effectively move your money offshore without moving it offshore, if that makes sense.
Yeah, no, absolutely. And I think you phrased it really well. And now some might say it's your job and your position to talk so positively about the product, but I think it is worth underscoring the point that you make. BlackRock is the largest, and that is substantial. And people can do a little bit of investigation, quite how big they are. And using that coupled with your experience at Satrix, I think is extremely beneficial. So when we're talking about the feeder ones, I mean, you're talking about ones like India, China, MSCI. I mean, there are a number of those. It's not just 2 or 3, correct?
There's actually quite a few, and this list is growing. And I think maybe to give your listeners a sense of just how well some of these global ETFs have done. The MSCI All Country World Index, was up more than 30%. Now we have a MSCI World Index that tracks the developed market companies. And up more than 30% in rand terms. You had the Nasdaq 100, which is the quintessential tech play, if you like, the largest 100 tech companies in the US. I mean, that was up 66% in rand terms last year. You have MSCI India that we track, or we feed into that. So in other words, it's MSCI are the constructors of the index. iShares track that index, and we feed into iShares. So it might seem complicated, but it's actually quite simple. It's a set of rules designed by MSCI, tracked by iShares, and we feed directly into iShares. And so the benefit of that is, and I think if you take a step back, what the purpose of having access to all of this suite of ETFs is, it's not to complicate investments. And I've heard the comment made sometimes that there's this proliferation in the availability of ETFs, and it's confusing investors because all this complexity and all this choice. At the end of the day, it's actually simplifying the investment process for you as a retail investor, because you're now able to build a well-diversified portfolio by holding different type of assets. So we have a global feeder, a bond feeder ETF, for example, that gives you exposure to thousands of bonds, sovereign bonds offshore. So you get offshore bond exposure. You can get exposure to developed markets broadly, or US tech companies more specifically, or the largest US companies, again, more specifically, or you can have access to India, China, and the list goes on, right? And I would suggest that investors that are interested to see our range, you can go on the Easy Equities platform, and you'll be able to see all our listed feeder ETFs. And so the benefit of that is you can actually build a well-diversified portfolio. And you can get exposure to emerging markets, specifically India, China, which is quite an exciting investment opportunity there. You can get exposure to developed markets, and you can build a diversified portfolio quite easily and at very low costs. And we know, if clients know one thing, it is that costs have a means of eroding your returns massively over the long term.
Yeah, absolutely. And saving on the cost has a massive compounding effect. I couldn't agree with you more strongly, though, that for me, it takes away a lot of the complexity, but it also takes away a lot of the risk, if I can call it that, because the thinking, the hard graft, it's done by people like you. I mean, you live and breathe this every single day. And so what I like to do is to fill up certainly my TFSA, but also my other wallets with ETFs that allow me to diversify, as you say. But I don't worry about, I don't do the work. You do the work. You watch it. So I think it takes away complexity rather than adding to it. And I think it's a point well made. So maybe talk a little bit about some of the new things that Satrix is up to. I mean, launching your Global Investor Index. Tell us a little bit more about that, please.
Yeah, so you'll see that there's a few new listings on the pipeline. One of them is the MSCI ACWI that we're listing in an ETF that provides you exposure not only to the developed markets side, but also adding that EM exposure, so emerging markets. And there you get exposure to India, China, and a range of emerging markets, typically between about 10 and 15% exposure to that, and then developed market exposure to the rest. So that allows investors that want exposure to the all country world index. It's about 3,000 companies in total there. If you want exposure to that, you can actually directly get exposure to that instead of combining your developed markets and your EM in the right proportion. So that we're launching. We're also launching, and we're quite excited to launch the Global Investor Index. This the SA or the Aussie Global Investor Index, which the All Share Global Investor Index, which is an interesting index because we've worked quite closely with the JSE to design an index that gives you more exposure to the inward listed companies in South Africa. In other words, your offshore listed companies. In other words, your Richemonts and those companies that have their primary listing offshore but have an inward listing in South Africa. Now, to give you a sense of why there's a need for this index, the JSE is actually harmonizing the different indices. So your clients might have seen that there's something called the All Share Index that's often quoted, but there's also the SWIX Index, or typically the capped SWIX Index. And most managers in South Africa, we've actually seen de facto assume that as their benchmark. Now, lay investors might look at that and go, hang on, why do we have an all-share index and
what's the difference?
Index? What's actually the difference between these two?
Exactly.
And this goes back historically to where there was a period where there was a lot of concentration in the all-share index, and specifically resource type exposure. Now, what the JSE then did was to create an index, and again, to take back to my earlier point, an index is simply a set of rules. So the JSE said, let's create a new set of rules where we downweight global companies, right? Where, in other words, your companies that have their primary listing offshore, and rather look at only the available shares in issue in South Africa, so listed on straight. And we weight the companies in the index according to what is available locally. The Aussie remained as historically, where you had an upweight to offshore companies. And specifically, they call it grandfathered companies. So, I mean, this is just a bit of a history overview.
It's interesting. Thanks. Yeah.
So grandfathered companies are companies that initially were South African companies, but then since moved their primary listing offshore. So that's what they called grandfathered companies. And this was before a specific cutoff date. Companies that were traditionally South African companies, but if you like, got a bit big for the local market, moved their listing offshore, but still have a inward listed inward listed companies or stocks in South Africa. Now, those are labeled grandfathered companies. Now, so that meant there was a difference between the Aussie and the SWIX for years. The Aussie was more of a global flavor. So in other words, more of your revenue for the companies that you're holding in the index came from offshore, and the capped SWIX was more of a local flavor. And so investors were able to kind of hold both, or show their preference for whether it's more SA Inc. or more of a Rand hedge over time. But what we've seen over the last few years is that there's actually been a natural harmonization of these two indices, with some of these grandfathered companies having corporate actions or doing moving their listings. And so what this has caused is that a lot of these grandfathered companies have actually reduced their weight in the Aussie, so that currently the only difference really between the SWIX and the All Share is a handful of companies like Anglos and the like. And on an absolute basis, I mean, the difference is very, very small compared to a few years ago where the difference was quite large. And so happening in March now, the JSE will now officially harmonize these two indices. The Aussie index effectively will fall away, or the Aussie methodology to upweight the global companies will fall away, and we're going to remain only with the SWIX. In other words, considering the stocks that's on the local exchange, so locally listed shares. But to just confuse things a bit, they're going to change the name SWIX back to Aussie. It's going to be so the Aussie becomes a SWIX, but the name changes to the Aussie. So it's a bit confusing. But at the end of the day, very simply for investors out there, this means that your local equity index will have more of a local flavor, and so have a downweight to the global companies, global inward listed companies. Now, what Satrix is now doing, we're launching now in March a global investor index, where we are looking at the global float of the companies in South Africa. So, local is lacquer, and we agree with that. But what we're saying is we're going to embrace the local aspect of this index, but just give you more exposure to the inward listed companies.
Basically more protection from a Rand perspective.
Exactly. So what this means is you're going to get more of a rand hedge likely, because these are you get quite a significant exposure to companies that earn the majority of their revenue offshore. And so in rand terms, if the rand weakens, that means those earnings are worth more. And so you're going to get that rand hedge. You're also going to get just more exposure to your Richmonds, your Billitons, your Anglos, some of these companies that are have a higher global float, because we're going to use the global float in actually designing the index. So something to keep an eye on if you want to just ensure that your local equity exposure has good rand hedge. The global investor solves that problem.
I think that's excellent. And just remind us, Nico, as this launch, when is it launching? We can give people a bit of a heads up on timing.
Yeah, so you'll see we've sent out the sends already. It's going to be in March. So just keep an eye out for that. And it'll be available through your platform on Easy Equities or whatever your broker you're using. Keep an eye on that for early in March, second week of March. It's going to come out, and yeah, it's we're currently in the IPO phase, which means and this is maybe a point that's worth remembering for potential investors out there, is that during an IPO phase or an initial public offering, that means investors can invest in the index in anticipation of its launch in March, but with the benefit of when you invest currently or participate in the IPO, your investment will actually be struck at NAV or net asset value. Now, translated into layman terms, this simply means 1,000 Rand that you're investing in this ETF will then exactly be proportionally allocated to the underlying companies. So that means you have no trading costs and the like associated with that slightly distort. The 1,000 Rand doesn't exactly match that. So think of it, if you invest in a currently traded ETF, your 1,000 Rand gets invested in that ETF, but you're still dealing through a broker that has bids and offers, and there's always a spread associated with it. So it's not massively material, but there will always be a difference. But if you participate in an IPO, you are getting that at NAV because it's not being traded. You're taking the physical amount that we get from the IPO and we are allocating that fully to the underlying. So that just means you're getting a better bang for buck, if you like, when you participate in an ETF's IPO as opposed to buying an already trading ETF.
And it's always exciting when when there's a new listing at the JSE, ETF and others. And we've had a couple of users and a couple of teammates that have been there. So yeah, users check it out. We'll definitely comment on social. It's always quite festive. Kudu horn gets blown. It's always really nice when that happens.
The whole shebang. Yeah, we're looking forward to that. This is not like you mentioned. It's not our first rodeo. We've launched quite a few ETFs. We've also amalgamated a few ETFs, so our range has expanded. Remember, with the with ABSA and Sanlam merging, you've seen quite a few new ETFs in our stable. So last year we spent a lot of time consolidating a lot of that. Just revisiting our offering and making sure there's no sort of contradictions and the like. But there are quite a few new interesting ETFs in our stable. So keep an eye out for that and get in touch if you want to know more.
Good. So as we wrap up, Nico, just a reminder, you can check out compare.easyequities.co.za. Also, their fact sheets, information on the ETFs, what's in them, costs, etc., all disclosed. And I would strongly encourage users to do your research as always. Investing is not one size fits all. So check it out, read, ask if you don't understand something. You can check out support.easyequities on the FAQs. We try and explain a lot. Satrix are great at doing education as well. Always happy to talk to users. So do the research. But yeah, as we wrap up, Nico, a couple of unplanned questions for you, throw you in the deep end a little bit. Do you know offhand how many Satrix ETFs there are currently?
40 odd.
So I embarrassingly don't know, and I think they're more than that. So we'll have to check it out because I think they're a whack more. But let's see. Your favorite one? You're not allowed to have a favorite child, but if you had to pick a favorite ETF, what would it be?
That's a very unfair question. I think my favorite ETF would currently be the Nasdaq 100, simply because that gives you exposure to the largest tech companies in the US. Which is, I think still with tech, I mean, being this emergent force, in the world, I still think that there's there's scope for it to grow even further, because here's the thing. So I want to ideally give you a short answer, but it's actually more nuanced. The funny thing is that we believe that tech or AI or the like, it's still in its infrastructure development phase, right? So the companies probably best suited to benefit from AI's maturity are the companies that just have scale and efficiencies and are able to secure chips and the like to just in order to actually just build the infrastructure required for the future. So I think the Nasdaq still has some ways to go, but don't see this as investment advice, please.
No, definite advice, but you're probably also influenced a little bit by, I'm just checking here, because I'm invested in it and I'm also very fond of this particular one. In fact, I was around in New York when this happened, and we had a big Satrix billboard in Times Square. It was one of my greatest moments, seeing Satrix in that iconic Times Square, that big billboard. But the last month, it's been up just over 8%, 3 months, 17.45%. If I go to a year, we're up to nearly 50% return. So apart from the reasons that you mentioned, the return has also been great. And for me, ETFs also proves the point. Have a reason, do your research, choose particular ones in your strategies, but pretty much leave them alone. And again, not advice, what I like to do. I'm surprised, happily so, just about every time when I come back and I look at my ETFs. They just sort of chug along and do their work. So, and I've just looked on the platform as well. We have just under 40 Satrix ETF. So
I think it's
one of us be
37 or
fine.
38.
Yeah. So so good answer there.
But because we've listed a few, and you have to keep your wits about you when it comes to those. So I think it's 37 or 38. Yeah.
Great. Well,
but
thank you.
If you wake me up, yeah.
Thank you very much for joining us, Nico, for your time. It's always appreciate when the Satrix team takes time out to chat to the Easy Equities community. We're really looking forward to this new index in March. We'll be sure to keep users informed about it, make sure that they have all the information to consider investing it. And we wish you and the Satrix team well for the rest of the year. Thank you very much.
Thank you, and thank you for the opportunity. Again, 12 March, that's when we're going to be listing the Global Investor ETF. And remember, the IPO closes end of this month. So if you want to participate in that, just I think the 27th of February that we're going to close the IPO. So by all means, it's a great opportunity to get in at NAV. And for all of you that use our products, thank you for your support. And we'll continue doing the hard work in the background to make it easy for you and transparent to understand what you're investing in. And thank you, Easy Equities, for your great support over the years.
Well, you are very popular with our users, and I'm sure that won't stop, Nico. Thanks very much.